Hello, everyone. This is Naji from Zurich. Greetings to all of you who have joined us today in the webinar. We are really thrilled to have with us Tim Hayes. Tim's from Ned Davis Research, and he's the Chief Investment Strategist. As well, before we start, I would like to say that this webinar is a collaboration between the Family Office and Petiole Asset Management. The Family Office is the most trusted wealth manager in the GCC, having served families for over 2 decades now. And they have offices in Riyadh and Bahrain. Petiole Asset Management is the asset manager, have offices in Zurich, New York, Hong Kong, and focused on private market. Tim, great to have you with us today. It's our first webinar of the year, and we thought there is no best way to start it without having a strategist view from Ned Davis. As a group, we've been working with Ned Davis for many years, but Tim, I think it would be good if you give a brief intro about Ned Davis Research. I know you have a presentation which also you will start with, and then we'll open it up for discussion and questions.
Okay, great. Thank you, Naji. Just briefly, Ned Davis Research is an independent research provider to institutions to help with their positioning on the markets and a lot of charts, tools, models, and guidance on where things are going. We've been around since 1980, so we have a global following of institutional clients. So maybe to sort of provide an overview, we can go to some charts, which always helps to think about things historically, where we are and where we're going. So let's maybe look at the charts here that I've sent along, and think about the when we were entering last year. So when we did our 2020 report for 2021, we summarized the outlook as a year of recovery. And then for this, we had this very good year last year, and with very little downside in the markets, in the stock markets. And this year, we entitled our outlook instead of year of recovery, it would be a year of reversals. And what I mean by that is, let's maybe go to the next chart and go to the first chart, and you can see there how the last year was a very strong year of recovering PMI growth, and same thing with the global manufacturing PMI and also the services PMI all recovered sharply last year. And you can see these gray areas of the chart are the global economic slowdowns. And so one of the reversals that we're starting to see is in that rate of global growth. We're not expecting a slowdown like we had certainly in 2020. We're not expecting a global recession, but we think it'll be a more moderate economic growth. Meanwhile, we have the response to the inflationary pressures that have arrived, and now that we're having a reversal in central bank policies, now especially with the Fed likely to raise rates starting in March. And also, following the slowing global growth, we have a reversal in earnings growth, which is, I'll show a chart of this a bit later, but this has been something that's really recovered, and now that's likely to moderate. And all of these reversals represent uncertainty, and so it'll be a year of more market reversals. And we started out the year certainly with a pretty sharp return of volatility, which has really been our theme. Our expectation is that we'll have more volatility this year, and we don't know whether or not we'll have something worse than we've had so far. We're not expecting the kind of market environment we had in 2007, 2009 during the global financial crisis, when the market benchmarks were down around 50%. The risk would appear to be more in that 10 to 20% area. A lot more volatility, a lot more corrections will be more likely, more frequent versus last year when we didn't have anything more than 5% on the major benchmarks. So let's go to the next slide and look at volatility and how what tends to happen is volatility. This I'm using the 100-day volatility indexes. So it's the 100-day, the average of the 100-day changes of 23 markets, and sort of it's a moving measure of volatility. And you can see how it spiked in 2020 and how sharply it came down. This is what often happens. Volatility recedes as the market moves onto the upside. And that was all anticipating the more favorable economic environment that I mentioned and the return of earnings growth. Well, now we're starting to see that change. Volatility has picked up. It doesn't mean we have to have the kind of volatility we had in 2020, but it does suggest it's going to be more uncertainty. And I think the volatility represents uncertainty. And as we have all these questions about monetary policy and how much of a slowdown in growth we'll have, and how much of inflation how sticky will inflation prove to be, supply chain issues, and so on, just represents a lot of uncertainty. We also have now the Ukraine-Russia situation adding to the uncertainties. So this all represents volatility. It's just something we're going to have to deal with, but we don't want to. We want to recognize that this doesn't necessarily change the longer-term trend. And that would require that the macro environment would significantly deteriorate, which is not what we're expecting. So more volatility is likely. Let's move to the next chart and look at, this shows the percentage of central banks whose last rate change was a decrease. In other words, more and more central banks have moved into a tightening phase. And this includes both emerging markets and developed markets. Now, the emerging markets have been the first ones to start raising rates, try to support their currencies primarily and fend off inflation. Now we have more Bank of England's raised rates, a couple other of developed market central banks, the Fed's likely to raise rates. And you'll notice in that box shows that the market tends to perform a lot better when you have more central banks in an accommodative policy than a tightening policy. And if it gets below, say, 30%, if you have widespread rate hikes, that tends to be when you have those negative periods like 07, 09. So this will have a lot to do with how much inflation ends up showing up here as to how tight. We know the central banks, the Fed is going to be reducing its balance sheet here this year together with the rate hikes, and how they manage that will be another source of the uncertainty the markets will deal with. The other question on the next chart is earnings. As I said, last year was really an ideal year where earnings growth came through, better than had been expected. What I do here is I take the prior year's earnings, expected earnings growth, and move it forward by a year so we can see if the earnings are coming through better than had been expected or not. And they have been coming through better than expected, but now earnings are expected to slow. And the question for this year will be, do the earnings remain above what had been expected, or do they actually come through worse and disappoint? And that could have another influence on volatility. As I said, if the economy is going to continue to slow moderately, we can expect earnings growth to slow. The year-to-year comparisons become more challenging. But how much does it slow? And that may be related to how much inflation and interest rate pressures start to weigh down the market outlook. Let's move then to the next chart. And what I'm showing here is we want to think about all this in the context of the very long-term secular trends. And we've been emphasizing that since 2009, equities have been in a secular bull market. I show this for the S&P 500. These trends do tend to be global in scope. You have participation among markets around the world. And you can see the market's been up 15% per annum since 2009. That's consistent with past secular bull markets where the market's been up at a double-digit pace. So there was a secular bull market from 82 to 2000, 42 to 66. And the big question is, are we moving into something like the 1960s and 70s when inflationary pressures became so persistent that inflation expectations rose? And that's when bond yields, I show that in the second clip of the chart, bond yields spiked out, started to break out decisively And then that combination of inflation and rising bond yields, rising interest rates, really sent the market into a secular bear market that lasted until 1982, until finally interest rates brought the inflation under control. And then we entered the secular bull market in bonds and stocks. That's not our expectation. Our expectation is we will remain in the same secular bull market that started in 2009. That's our base case. And also the bottom of this chart shows commodities. And if we would be going into a secular bear, commodities then would be breaking out to new highs and maintaining a much stronger advance than they've had so far. We still haven't gone back to new highs yet on commodities. And you'd really have to get into a more inflationary environment, most likely, for commodities to be the best performer among these asset classes over the longer term. And then let's go to page 6. Just a few more things I'll talk about here. This is how we're positioned, how we've been positioned since 2009 in our asset allocation. We allocate it between stocks, bonds, and cash. Benchmark allocation of 55% stocks, 35% bonds, and 10% cash. And we've been overweight equities for most of the time. We went to underweight in 2018 and stayed underweight until after the 2020 global bear market and global recession. But then really the indicators started to improve decisively. We use models to assess the weight of the evidence. And it really said where the place to be in 18, 19 into 20 was bonds as yields were dropping. And then that changed last year decisively, and we went to underweight on bonds. But what we've done most recently, we've actually cut our allocation from the maximum. 70% is as far as we would go. We went to 65%, moved some of it back into cash in the rising interest rate environment. As we see shorter duration areas doing better, we brought now to a market weight allocation in cash, underweight in bonds, and staying overweight equities, though not at the maximum, recognizing again that we've entered a more volatile year. And then on the next chart, if we could go to the next chart, what I'm showing here is what happens in, again, these are the beginning of the secular bull markets. Again, 1942 is the start of one, 1982, 2009. And what I'm showing here is we get cyclical bear markets are inevitable along the way. We're going to have these declines. You can see after the 42 bottom, 23%, 16%. After the 82 bottom, 16%. 36% is the 87 crash and 21%. And then after the latest bottom, 17% down, 14% down, and then 37% in 2020. So you can see here, the 2020 decline was much like the 87 crash, very short, extremely sharp, but very short. And that's what we tend to see in these secular bull markets. You get cyclical bears, but they tend to either be shallow and drawn out or very sharp and short. They don't tend to be the kind of decline we saw from 2007 to 2009 when the market was down. We'll talk about this chart. What I was discussing was the secular bull markets. There have been 4 of them going back over the last 100 years. We started one in 2009, and the risk is that we'll have another one of these cyclical bears. We don't know when, if it will be this year, if it will be next year. But as the cyclical bull continues, the market gets more mature, and you're more at risk of entering a bigger decline than we've had so far, something in maybe that 10 to 20 or 25% area. Let's go to the next chart and look at the other issue is valuations. And here you can see that the earnings yields have actually improved, in that the earnings have come through so well that the market's valuations have improved. And stocks don't look overvalued relative to bonds. And you can see that in the spread between earnings yields and bond yields, still a very wide spread. This has been the case for the past really 20 years. And this is something that really would change the picture, raising risks of sort of a 1960s, 70s secular bear if the bond yield would rise above the earnings yield. But we're very far from that. In fact, we're even further from that now that earnings yields have risen further. This is based on the average of 42 market indices. We take the median earnings yield relative to the median bond yield. Also, let's go to the next chart. And this will be the last chart I'm going to show. And this is, we also, when we think about interest rates, think about real interest rates and think about what do and what does interest rates look like after inflation? And you can see these are the lowest real interest rates we've had since way back in the 70s and 80s. And as much talk as there is about rising interest rates, we're a long way from real interest rates turning positive. And actually what this chart shows is this helps explain why gold has held up here. You're kind of working its way higher over time, benefiting from the real interest rates. So that'll be another big question going forward. Will we start to see real interest rates turn positive? So that's pretty much a summary. Just to summarize again, we're looking for a more challenging year, more volatility, slowing economic growth, but more of a moderate slowdown. We're not looking for a recession. We're not looking for an inflationary spiral. And the stock market should, bond yields will be rising, interest rates will be rising. More challenging year, but doesn't have to be a negative year from start to finish. So I guess I'll stop there and see what else we'd like to discuss here.
Great, Tim, and thanks for a summary of your view. So if I may, you mentioned reversals, a year of reversal and uncertainty. So what do you see as the reversal, the most significant reversal that we will see? And at the same time, what do you expect this year to be where we would still have certain indicators that are sticky? For example, inflation, supply chain. Am I right to say that you guys are not assuming a reversal of this, but maybe more of a reversal of economic indicators generally? Just if you can elaborate on that reversal term.
Yeah, so what I meant is that a lot of the trends that we saw last year will start to change. A slowing growth, certainly probably the most significant will be, as we know by now, there will be a change in central bank policy, especially by the Fed. That's probably the most significant reversal in that it's something the markets haven't had to contend with for several years. The idea of the Fed raising rates and reducing the balance sheet and removing accommodation. So that is, as I said, our view is we will see a slowing of economic growth, but it won't be as significant in that we're not looking for a recession, and we're not looking for, I would not say serious bear market is likely in equities, but it's pretty much the interest rate trend, I'd say, is probably the most significant reversal. And then, as I said, the return of volatility, just more frequent corrections and maybe more severe corrections than we've been used to here recently.
And I mean, you've been in the market for 40 years almost now. So when you look at what is the environment today, do you feel it's all deja vu and it's cycle again, or do you see certain pockets of uncertainty or things that you haven't seen in your career that you'd say, that's something new?
Well, I think in any cycle, there's always something that's different in some way. A lot has to do sort of advances in the market and technology, different pockets, the meme stocks that got so popular, and then we didn't have cryptocurrencies in past cycles. But I'd say the general behavior of the market is something we've seen recently that is very consistent. For example, just this past week, we saw the market react to worries about interest rates, a big rotation, money coming out of technology, going into some of the other areas. I would call it more of a rotation than a broad-based decline. But then we get to Friday and the market's down, and then Monday, you get what we often call a selling climax, a point of maximum pessimism and capitulation. And then what typically happens is the market will build a base. You'll go up, you'll come down, you'll test the lows, you'll go back up, and you'll start to form a bottoming process. And that's really what we've been seeing even this week. It's been very consistent. It's as much as the size of some of these moves have gotten so much attention. It's really pretty consistent with what we see when a market has corrected and you sort of have to have this transition from extreme pessimism to a build restoration of confidence, which happens as the market, comes back down. Tesla succeeds in that test. And, we've seen it so far intraday, and, we'll see as it starts to become more evident with closing market data. But, I think the behavior of the market is, we've been through other periods like last year. 2017 was very, very similar. In 2017, the market had very low volatility. If you remember back then, the markets were focused on the globally synchronized economic expansion following the economic weakness of the prior 2 years. And then earnings growth came through. The valuations improved even as the market rose. That's what we saw last year. But then it also led to more a complacency, and the market wasn't prepared when the global slowdown arrived in 2018. And then we entered, at the time, the VIX spiked higher. That's what's happened, this year now. Actually, it was late last year we went up above 30. So, these things do tend to move in cycles that are consistent, and that's why it's good to study history and try to understand where in the cycle we might be based on some past consistencies.
And if the main reversal that we should be looking at is the normalization of rate, I think it's less about the rates themselves going up, but more the pace of normalization that happens. So the speed at which this happens. From experience, what have you seen, and how should we be prepared for this, or in terms of the behavior of the asset class during rate hikes and the market generally?
Yeah, usually the market will withstand the early stages of a rate hike, because at this point, the markets are tending to recognize that as long as we're still in a favorable earnings environment, and the reason why the rates are going up is really a result of the economic growth and leading to more inflation. And that it's not just a supply chain issue; it's also that we do have had a strong economy, and that has had a positive impact on earnings. And so usually what happens is after a series of rate hikes, the rule of thumb historically has been 3 rate hikes. There have been exceptions to that. Sometimes we've had a lot more rate hikes, but I do think it's right. The speed of the rate hikes will have an impact, and also whether or not the markets perceive this as to be that the Fed is behind the curve. And if the Fed is behind the curve and other central banks are behind the curve, then what we'll start to see is the yield curves will start to flatten sharply as the short rates rise quickly. And that becomes a more negative situation. We find that stocks tend, when you have a flattening and especially inverted yield curve, that tends to be very negative for equities. So I think we want to look at the term structure, see what interest rates are doing and how quickly they're rising, and then all of that. I mentioned real interest rates. How does that compare to the inflation that's coming through? And but yes, I think the speed of it, and really, the question we always ask is what is priced in. I mean, right now it's pretty clear that I think part of this latest sell-off has been 4 rate hikes are now expected. Well, if it turns out there's more inflation, then the Fed's market expectation has to change. Well, maybe it's going to be a half rate hike in March, or it's going to be more than 4 rate hikes this year. That could set off another round of selling. And but ultimately, the question is going to be: do you have the kind of rise in interest rates that's going to really do what it did in the 70s? When it's really going to cut off the economic growth, and that's going to probably require a much more inflationary environment than we've had so far. And our view on inflation is that a lot of this has been base effects, and as much as the supply chain issues have been a problem, we're already seeing signs that inflation is going to moderate here, and that sort of will remove that fear of a more aggressive central bank policies going forward.
Thank you. I have questions, and there is a place where anyone can ask any questions. So let's take some question. I have a question from Carl. He's asking, how do you explain the big volatility witnessed for companies outside of the S&P? So S&P indices are down 15, 17%. Small caps are down 60, 70% from the 50-week high. How do you explain that?
Yeah, I think that's been a big issue of this market. It's been extreme rotation going on, and I think especially in the sectors that are most sensitive to rising interest rates, like technology. We've seen as the money going out of sectors like technology and going into sectors that tend to benefit from rising rates, like financials. So as long as, especially if the yield curve doesn't flatten, and you get in energy and has held up relatively well. Materials, basically the value oriented cyclical stocks have benefited. So it's been a lot of what I think we've seen has been and this is what tends to happen in these markets, is that if you have a big disparity, big difference in valuation, some areas of the market extremely overvalued, the tech sector relatively overvalued, had about a 3% earnings yield, and tech has a lot of weight in the U.S. So the U.S. has been really dragging the global markets lower, given as it's been underperforming. And but we've seen some areas of the market, in fact, despite Russia and some other emerging markets that have done really poorly, several more than I think about last time I checked, more than 10 emerging markets actually were up so far this year, as a lot of other areas declined. So yeah, I think it's been more of a rotation, and I think it's really gets down to this point of interest rate sensitivity. If you're and we can do this by looking at correlations. Technology's relative strength has a inverse correlation with bond yields, whereas the areas I mentioned, energy and especially financials, are positively correlated. And so that's what happens at this point of the cycle when the economy is gaining momentum. Some of those sectors will benefit. So I would probably consider it a sign of a rotation.
But shouldn't small cap value be a good place from that perspective? And because the question is also that small caps have sold off quite aggressively.
Yeah, I think that's small caps. That's probably generally one of the sort of anomalies. So, but it is true though that small caps are generally, if you look at, and we look at Russell 2000 and look at some of the proxies, small caps are generally interest rate sensitive. So I think again, it's a reflection of areas that are don't do well when interest rates are rising, have been hit, and have been bearing the brunt of the selling. Whereas the areas that maybe are even positively impacted have done better. So I think again it gets down to why small caps have done badly is their interest rate sensitivity. So
if we think about from the sector perspective, it is a rotation from, like, as an example, technology out of technology into more strengths on financials. When you think about countries, do you see do we have the same comparison, i.e., emerging markets doing worse than developed markets or other places in the world?
Yeah, what we've seen is actually one of the interesting developments. One of the weakest markets for a very long period of time was the UK. What we do is we use the MSCI indices, and the MSCI UK index is very heavy, relatively heavy on resource and material stocks. It has almost no technology; it's 1% technology. So the relative strength of the UK has come back really sharply. And I think a lot of that, again, is a part of this rotation, the fact they haven't been affected by technology. Same thing, emerging markets. Of course, there's lots of different emerging markets, but generally they have, like the UK, they have resource stocks and they have financials. And unlike the US, which has more weight in technology than financials, tech has, especially China and more Taiwan and those markets, South Korea, have more technology on a relative basis. But generally, the EM index is more balanced in that way. And some of the emerging markets have held up relatively well. Even China has actually held up a lot better than the US. So I think again it gets down to the exposure that a lot of these regions have to certain sectors. That helps explain sort of some of the relative performance. And as I said, the U.S. having a lot of technology has been affected by the fact that the tech stocks are more negatively affected by the rising interest rates.
Okay. So a question from Raja, as you stated, commodity markets have performed very well. Are you advising to continue investing in that sector, commodity?
Yeah, I mean, our work remains, say the commodity uptrend is still well intact. One of the things that we noted over the summer was the breadth of commodities. It became less decisive. Fewer and fewer commodities were remaining above their 50 and 200-day moving averages. So it looked like it was perhaps getting extended, but then along came Omicron, and sort of these new worries about supply disruptions arose, and commodities kept turned around and started going again, especially oil, energy recovering, and commodities have continued going. So I'd say right now commodities are in a cyclical bull market, but as I talked about earlier, this doesn't mean that they're moving into a multi-year secular uptrend. Once there's, I think, a balancing here, when we start to see the supply issues start to ease, and then the economy starts to slow, so the demand starts to come off, the supply-demand balance shifts, and then then commodities. Then I presented it this way entering the year. I thought commodities would probably move sort of in a range this year, maybe a trading range instead of a sharp uptrend. They'll be sort of moving sideways in this environment. One I talked about gold earlier. Gold sometimes diverges from other commodities. Gold's been benefiting from negative real interest rates. We remain bullish on gold in that we see that uptrend remaining intact. It hasn't been a very impressive uptrend, but it is still trending higher. So we're staying with that position right now.
Okay. A bit on currency from a question on your view on US dollar against euro, and maybe you can expand a bit more on your currency view.
Yeah, well, I've been skeptical about the dollar. The dollar had this, and especially against the euro. If you think about the dollar index, 57% of the weight is the euro. So really, you can almost use the dollar index as kind of a euro inverse proxy for what the euro is doing. And then, but the point is that when the interest rate expectations changed, the dollar had a bit of a rally. But if you look at real interest rate differentials, especially between the U.S. and Europe, or the Eurozone, and then the U.S. and Japan, it's still negative. In other words, U.S. real rates are still lower than they are in Japan and Europe. So that's not that was different back in the late 1990s when the dollar had a more sustained advance. You had positive real rate differentials. And they can also look at this more broadly, and we really just don't see that interest rate advantage for the dollar. So, we're currently neutral in the dollar. We have composite models which had shown the dollar, it's still well below its earlier highs, and we had gotten a sell signal on our dollar model last year, and that signal went back to positive. So we went to neutral, which is where we are now. I don't see the dollar running away on the upside at all, and therefore, I don't see the euro collapsing here either.
In your asset allocation, you mentioned a 35% allocation to bonds, in the if I correctly remember, and in a rising rate environment, and that environment we are in, where are you putting that allocation?
Yeah, so the allocation to bonds, we use a 35% benchmark allocation, and this is just to sort of put a framework around how much exposure you should have, but we're actually at 25% bonds, so we're underweight bonds, and we're at 10% cash, which is the benchmark. So even though we have more weight in bonds and cash, we've actually, on a relative basis, more favorable on cash. So basically, you want to shorten duration. It's been sort of the point, and it's also the point with technology. Why you don't want to be overexposed to longer duration. So you want to shorten duration. You want to move because what will happen is that if we're moving into a broader, which is global, also we see this, in all the regions that bond yields are moving higher here, have broken out, and therefore you don't want to have exposure to bonds because those portfolios will lose money in a rising rate environment, and your cash will hold up. You're not going to lose money in cash, of course, especially if you're going to have rates starting to get a little bit of yield returning. Then you want to be short duration, hold more cash relative to bonds, longer
And
term.
at the same time, you can be long credit because credit conditions and financial conditions are still fine. So if you are short duration, long credit, that should be a way to implement this allocation.
That's exactly right. We have financial conditions indexes we look at, and credit conditions, and those have not deteriorated, which is another reason. No, those have remained favorable. We're not seeing the kind of stress like we had during the global recession of 2020, and which created a lot of volatility. And and that's, I think, consistent with the idea of what we've had here recently in the stock market, thinking about how high yield bonds. I have some indexes, I call them risk on, risk off indexes, and I put positive correlators in a risk on index and inverse correlators in a risk off index. And high yield bond prices have the highest positive correlation with equity. So they really are sort of an equity proxy. And so if I'm staying constructive on equities, you're probably going to be doing okay in high yield, especially relative to to the treasury or government bonds that I was talking about. So yeah, I would say we can still be constructive on high yield.
Okay. Tim, which risk is the most overlooked risk by the market today?
Well, that's always a difficult one. I'd say, we certainly have had the markets focus. What has the market been focused on? Clearly, it's been inflation, interest rates, the concern, the geopolitical concerns. COVID has, of course, been on everyone's mind for the last 2 years. I think maybe valuation risk has sort of gone to the background because, what we've had is, first of all, last year when you have earnings coming through, valuations improved even as the market rose. And now with the market selling off, valuations improved even more. But I showed that chart earlier of earnings growth. And, at some point, the market starts to expect the earnings to keep beating expectations. Well, what we've already started to see is that beat rate has started to lose momentum. So, the risk is that we get maybe later in the year or get into another earnings season. It doesn't have to be this one, but we get into an earnings season and earnings start to disappoint to such an extent that the valuations start to worsen. So if the market holds on and then the earnings don't come through, then valuations start to worsen. And so valuations, again, enter the picture more broadly than just, like I mentioned earlier. I think that was one of the reasons we've seen this rotation, because tech stocks were the one area that had gotten ahead of where the price had gotten ahead of the earnings. But more broadly, if you had the major indexes would start to appear more overvalued because the earnings aren't coming through as decisively. I think that could be the type of thing we saw I mentioned 2018 when earnings became a negative influence. So I would say that's maybe something we're not hearing as much about that's, could come back into the picture.
And how has the investor sentiment been? You look at indicators like Bull Bear Index and others. How has been that sentiment since the beginning of the year, of course?
Yeah, I mean, this sell-off we've had I have a global sentiment composite that's dropped down to levels we saw last October, and actually, I think it's probably at the levels we saw, getting close to levels we saw back in March 2020. So we've definitely seen. We have other sentiment indices we look at, and generally they're consistent in showing we've had really a pretty shift toward pessimism. I think part of the reason for that is that the stocks in areas of the market that get so much attention are the ones that have really been weakening here. All the big name, we call them fan mag stocks, the big tech stocks, and that have really dragged things down, and the focus on the U.S. market, whereas less focus in some areas that have held up well, but it's created a lot of maybe overdone the pessimism. And but that's actually, we always want to think contrarian when we see that much pessimism. Could mean that most of the bad news has been priced in, and now the market can start to look ahead to maybe things being less bad, or at least more favorable than the market had thought. So yeah, I'd say the answer is that pessimism has starting to show up pretty broadly right now in our work.
And part of your the way you describe it is secular and cyclical maybe you can elaborate a bit more on this. And I know you have certain charts that show a cyclical sell-off and a secular bull. What is on average this means for the market? So maybe you can touch on this a bit. There is a question on gold. I'll take this one because it was already answered by Tim. I'm taking your spot. I'm answering your questions now, Tim.
That's good. Sorry about that. I don't know why I'm having issue. What's going on here? But
I told them you're in Florida, so not sure if that's connected.
I don't know, but hopefully we can stay live here. So sorry, the question
I had, Tim, is on just to explain around your secular, cyclical, and then you have these frameworks of cyclical sell-off in a secular bear market, and what does this mean? A secular bull market, and what does this mean for average cyclical sell-off in a market? So I wanted you to touch a bit more on this view, since you mentioned it many times, secular and cyclical.
Yeah. So what tends to happen is, as I mentioned this earlier, secular bulls tend to last. Your cyclical bulls within a secular bull tend to last on average 800 days. This one has been, we're getting a little more than half that, so they can last a lot longer and be about bigger, more than say 120%. And this one has been up about 80%. So they tend to last a lot longer. They tend to be about bigger, and then the cyclical bears tend to be a lot shorter and more shallow. The cyclical bears tend to be in around that 20% area. They tend to not last as long, whereas the cyclical bears within a secular bear are a lot bigger and last a lot longer. So I think that's the general point. If we understand the secular environment, and that's why you get those annual returns on double digits, because when you have a decline, the market, as it did in 2020, the market will recover more quickly because you have a relatively short cyclical bear. So the market recovers and is actually back at new highs. So over the course of that 1 year period, you have a positive return. So yeah, that's why the secular determination is pretty important. And in the secular bear from 2000 to 2009, you did have that run up from 2003 to 2007, but it was one of the weakest bull markets historically. It was a very low annualized return. That market worked its way higher, and actually what we saw was that the bubble of 2000 in tech had been transferred over to the housing market and the old subprime crisis that developed in 2007. So yeah, that would be my response.
So then, assuming we're going to live more volatility in a secular bull, which means in the long term the market is going to be positive, but we're going to have some cyclical sell-off, investors should expect sell-off like the one we've just had and others to come, where the market can drop 10-20% in a very short period of time. And this is something that maybe investors have not been used to see before COVID, and we should be ready to see more of this volatility going forward.
That's right. I think even they don't even have to be 15-20%. You can just, on average, historically, there's been 10% correction a year. We didn't have one last year, and we had one in 2020. Of course, it was a lot more than that. But yeah, that's something that investors have maybe had forgotten, that these kinds of declines, this is pretty a normal part of the process. The market's going to have these corrections, and and that's why we have to understand if the macro environment really is supportive of a much worse bear market. That means you're going into a much more negative economic environment with much worse inflation or interest rates or deflationary pressures like we saw during the 2000s. Okay. So yeah.
Look, I usually we put 45 minutes for this call. We're extending it a bit because of the short technical. I have a question on the COVID crisis, and with every crisis there is an opportunity. When you think outside of your indicators and you look at the world today, what do you think are some of the new long-term trends that maybe have emerged from COVID that should be considered today, that every investor also should consider outside of the day-to-day market movements?
Well, I mean, it certainly has perpetuated the trend like this call, toward remote communication, remote working, the technology supportive of that has certainly been enhanced, and also, the realization that, we can have a different a work environment that can be more flexible going forward. So those seem to be like adjustments have been made that have had some positive, or at least some more will have more staying power. I mean, we're not going to go back completely to where things were. As companies have found they can be more efficient. But maybe the other thing would be, one positive would be maybe the emphasis on vaccine technology that's resulted from this is that, some vaccines came along pretty quickly. And, that awareness of pandemics, I mean, nobody really talked about pandemics before this happened. And, now we're quite aware of it, obviously. So, that should be a positive, I would think.
Right. Great. So I think we answered most of the questions. There is a question on crypto, always comes as one. So what's your view there? I don't see Ned Davis talking much about crypto, but what's your view?
Yeah, I've written about it a few times, and basically my takeaway in doing research on this is that, we like to develop models based on historical relationships between data series and markets. And you can't really do that with Bitcoin because it doesn't have much history. So you can't look at past cycles, and it doesn't correlate well. So you can't really say you can use interest rates as, like I was talking about earlier. There are some relationships between stocks and bonds and interest rates and stocks. And so, but you can't do that with Bitcoin because it doesn't have a consistent correlation. And as I said, you don't have a lot of history, so you can't look at, say, long-term secular trends or even cyclical trends we were talking about. So really, the only thing you can really do with Bitcoin is create short-term technical indicators, and that speaks to the real risk of Bitcoin, is that its volatility is so much greater than any other asset class that if you're going to get into Bitcoin, you're going to have to be ready for a lot of volatility, and either you're going to have to try to trade that, which most long-term investors aren't going to really be pretty good at. So I think from the way we look at asset allocation is to, when you think about for growing, for capital preservation and growing a portfolio, I don't think Bitcoin really represents a viable option at this point, given its volatility and also the increased regulations. More and more countries are cracking down on it. So I'm not a bottom line, and I personally am not a big fan of Bitcoin.
Okay. And what about real estate?
Well, real estate certainly has been a strong performer, but if we're going to have a much worse interest rate environment, then that risk starts to become a bigger risk for real estate, which has really been supported by this, a chart I showed earlier of the long-term downtrend in interest rates and bond yields, and keeping mortgage rates low. And so, for now it's probably okay. But if interest rates really do start to become a bigger issue globally, then that could put the brakes on that trend. So,
okay. Great. So let me maybe summarize and then relate it to how we are running asset allocation, Tim, for you. So it looks like we are on a long-term secular trend. That long-term is there. There will be cyclical sell-offs, and that's something we have to live with. More uncertainty, and the real risk here, on one hand, is the reversal or the interest rate hike that people should look at. Inflation for you guys is not a big issue, but also at this other side that the valuation is not something that people are taking into consideration today, or it's not in the, at least for now, people are putting it on the back burner for us. And then from an asset allocation perspective, you're overweight or still quite into equities, underweight bonds relative to equities, and then overweight cash. And then within bonds, your short duration allocation. So that would be more. So if I was to relate it to our way of doing things, I think we agree with you on the secular bull, i.e. the long-term trend. There is slowdown, but it's still positive. And the way we express equities is overweighting private equity. The way we express fixed income bonds is doing private debt, and we're also a bit underweight real estate and private debt over private equity, as we see the interest rate being a risk to the market generally. And again, we lost Tim, so but it is the conclusion. So for us, I think the same way we've been managing the portfolio in a way that we are living in a long-term secular bull. I think the cyclical sell-off that we're going to see is not something that our clients see, because we're investing anyways in a very long-term portfolios. So that volatility and that mark-to-market is not something that we are seeing, and therefore we're able to minimize the volatility, but still invest in assets that's going to compound over the long term. And I was saying, Tim, compared to you, the volatility that investor and the uncertainty that's going to live with us in the short term, for us, given the structural design of our portfolios being a bit more longer duration, that's not something that we see on a mark-to-market basis. So we play the long-term secular trend by minimizing that mark-to-market movement from clients. I don't want to lose you again, so I'm gonna conclude here, and I wish we had it all consistent, but hopefully everybody managed to get the message.
Thank you.
Okay.
Thanks a lot. Enjoyed that.
Thank you, and have a good year. Bye-bye.
Yeah, you too. Bye.